Yeah, thanks very much for inviting me. Is that good? Yes, so I'm also, as did Francesco, try to answer the question before us, which is, should macroprudential policy target house prices? And I think the shortest answer to that is no. A slightly longer answer to that is no, but. And I'm going to give you an even longer version as I go through my slides. So we definitely are seeing a lot of activity. Francesco has given some examples. If you look globally, there's growing use of macroprudential policy around the world, both in emerging market economies that have traditionally been sort of the leaders of this, but also increasingly in advanced economies. And indeed, the blue line here shows the LTV type measures, and they are the ones that are growing in use most strongly, both in advanced and in emerging economies. So that raises a number of issues. It raises the issue of what are the objectives. Secondly, what tools can we use? How well do they work in achieving the objectives? There are operational considerations which I'm going to touch on: when to act, and also how to act, considering benefits and costs of action. And finally, I'd like to draw attention to the need to complement macroprudential or prudential tools narrowly defined with a broader package of policy measures that draw from other policy fields. So the ultimate objective of macroprudential policy, at least as we see it at the IMF, is to use primarily prudential tools to limit systemic risk. So the key concept is systemic risk, which again is defined by a risk of disruption to the provision of financial services that can cause serious negative consequences for the real economy. So we're caring very much about the real economy at the end of the day. But ultimately, of course, what we're in the business of is to reduce the frequency and severity of financial crisis, even though, as John said, we never are likely to prevent all of them. There's intermediate objectives to macroprudential policy, which are important and which will, I think, lead to the answer that eventually I'm going to give on the question posed to the panel. So there's two intermediate objectives here. One is to increase the resilience of banks and borrowers to aggregate shocks by building buffers that help maintain the ability of the financial system to provide credit through adverse economic conditions. And there's a second intermediate objective, which is to contain the buildup of systemic vulnerabilities through time. And in particular, what we're after is to try and reduce pro-cyclical feedback between increases in asset prices and increases in credit, and thereby trying to contain unsustainable increases in leverage, debt burdens, and volatile funding. So to emphasize this, again, the objective is not to try and control asset prices, but to control the pro-cyclical feedback mechanism that you may have from increases in prices driving up credit and so forth. The tools for to try and do this, increasing resilience and trying to contain this feedback, I think there's three sets of tools that can be considered. One is capital requirements, sectoral capital requirements, so essentially increases in risk weights for exposures to the housing market. And that's useful to increase the resilience of banks to shocks, to default, borrower defaults. You can also hope to have some effect on credit supply, but that's the secondary objective. The second type of tool is a limit to loan to value. And again, here the important objective is that this can increase the resilience of borrowers to an asset price shock. So if you have a tighter LTV ratio, that reduces the chance that a correction in asset prices puts everyone underwater and leads everyone to want to default strategically. So that's a key objective here, to increase the resilience to asset price shocks. You can also hope to reduce loan demand to some extent. And then the third set of tools is constraints around debt-to-income ratios. So a DTI or a DSTI cap. And the objective here is quite similar again to the one for LTV. The main objective is to try and increase the resilience of borrowers to shocks. And this time it's not so much the asset price shock, but it's shocks to interest rates that we want to try and that we want to increase resilience to, and also shocks to income. So you can have an economy where the asset prices never collapse, but it could be that a recession puts everyone out of work, and then borrowers will default on their loans despite asset prices holding up. And so a DTI limit is useful to increase the resilience of borrowers to that kind of event. It's also useful to increase the resilience of borrowers to interest rate shocks. So if you are in an environment where the central bank has kept interest rates low for a long time, essentially there is a risk that everyone is going to be quite exposed to the risk of reversal of those kinds of policies where interest rates rise sharply. And that's the shock that you want to insure against here, using the DTI or DSTI type tools. So how well do these tools work? Some people say, well, we don't really know much about macroprudential policy and how well they work. Actually, we think at the IMF that there's been quite a bit of evidence that's accumulated over the past few years. And I think we have an idea as to how well these tools work in achieving their objectives. And here's my take. So for capital requirements, I think the evidence is that they can increase the resilience of banks. But I think the evidence is that marginal changes in capital requirements aren't going to do much in moderating credit growth. And that's the experience also recently, I think, across countries. For limits on LTV, I think there is some evidence, some good evidence actually, that those tools are good at increasing the resilience of borrowers. So there are a number of studies that show that a tighter LTV ratio leads to lower default rates for a given shock to asset prices. So they are useful in increasing resilience of borrowers. They can also, these LTV ratios, have some moderating effect on credit, and that's been shown in some studies. But importantly, most studies conclude that the effects of LTV ratio caps on asset prices is not particularly strong. Okay, so that's one element here in the answer to the question. The evidence is not super strong that LTV ratios are good at controlling asset prices. And indeed, turning to the issue of activism or not, one issue with the LTV ratio is that as asset prices go up and you keep the LTV ratio fixed at a given level, asset prices will mean the increase in asset prices will mean that the sort of the credit, the debt levels will rise or can rise in tandem with the increase in asset prices. So it's not going to actually be super effective at containing this feedback between asset prices and credit. And you may therefore need to readjust the LTV ratio as asset prices rise. You may want to go from, 80% to 70 to 60 when you have a real asset price boom that drives up credit. For DSTI and DTI type tools, again, there's good evidence that these tools do their job in terms of increasing the resilience of borrowers to income and interest shocks. There's slightly better evidence also that they can contain that feedback between asset prices and credit. And the idea is that these tools are around income, constraints relative to income. So as asset prices rise, income levels may not rise as fast. And so if you tie the credit to income, you achieve more of a stabilization, more of an anchor than you would from an LTV ratio. When to act? So again, to the question, yes, house prices are important. They are a key indicator in our sort of IMF framework for providing advice to countries that I'm showing here. So we have the house price appreciation rate and things like the house price to rent and house price to income ratio as one of our core indicators for action. But we couple this with indicators that try and capture credit, essentially. So do you not only have a strong rise in house prices, but do you also see that credit is expanding fast into that segment? And perhaps the share of mortgage credit in the bank's books is going up quite fast. So those are the two indicators that we combine to try and answer the question, well, is there this kind of pro-cyclical feedback between asset prices and credit that we think warrants action? There's additional indicators which I may not want to get into, but again, it's important to be granular and to look at more closely at what are the risks, including perhaps, do you have loans that are denominated in FX? Do you have loans that are interest-only loans and so on? So where there needs to be particular attention. When to act? I just wanted to give you a couple more country examples here. So we look at these indicators. Countries are looking at these indicators. But I think the recent experience is that you may actually be better off reacting a little bit more preemptively or taking action early, before you see these indicators going up strongly. So the UK is a good example where there's been preemptive action, putting in place the LTI cap, essentially, even though overall the worry was more moderate. And Ireland is a similar story where actually house prices and other indicators weren't signaling an alarm, but the authorities thought it'd be a good idea to put in these types of tools, sort of a little bit as a break on further overheating. Considering costs and benefits is important when you're thinking about macroprudential action. I'm going to keep this brief here, but essentially there's two types of costs from these kind of ratio caps. One is efficiency costs for borrowers who cannot access credit, and the other is output costs that you can estimate to be sizable for LTV and DSTI type tools. So you want to consider those costs and design your action in a way that mitigates the costs while it achieves the benefits. And just to give you an example, I guess we can come back to that. So you can perhaps have a design that rather than limiting the LTI for everyone, you can say, well, we would like for the banks to have only a certain share of exposures at high LTI multiples, for instance, which is a way of sort of mitigating some of the costs for borrowers. I want to come to my last topic here, which is the potential use in combination with other policies, because again, that's important in the context of, well, how do we think about asset prices? So we think these capital requirements, LTV, DTI type tools should be complemented by other policies if two conditions hold, if you want. Asset prices go up, but also there is a concern that this leads to an increase in indebtedness for the population. Again, I don't think that, and I think the evidence shows that prudential tools on their own are not likely to be fully effective in containing these kinds of feedback mechanisms. And so you want to reach for other tools potentially as well. And that can be the case in particular if essentially the supply of housing is constrained, and at the same time you have strong demand for housing from some source. So, and that's actually the situation in many countries where you have an inelastic supply of housing, and then you have strong demand coming in, and that drives up asset prices. That can also drive up credit and indebtedness of the local population. So you want to look at these supply constraints as well, and you look at the demand and where that comes from. And so you want to respond not just with prudential policies, but also potentially with structural and fiscal policies. And here's my list of things that you can do. So one thing you can do in 2 minutes is to remove those supply constraints. So a lack of supply can push up prices. We see this in a number of countries around the world. And you can do something about this. So, for instance, you can relax zoning restrictions. You can also put higher taxes on land or properties that are unused. So you can do things around increasing supply. The second thing you can do is you can remove or try and remove fiscal distortions that may actually be the driver of increases in debt. So a number of countries provide generous tax relief for mortgages to sort of help their population. But these create the wrong incentives because they lead for the population to want to carry debt. And so it's useful to take away those tax distortions. And some countries are trying to do that. The Netherlands is one of them. Actively using fiscal tools is my final one, where I think indeed the evidence is, if anything, that something like stamp duties capital gains taxes, but in particular stamp duties can affect prices more directly than the LTV, the STI type tools. I think that's been found certainly in Singapore and in Hong Kong, that these kind of tools were the decisive ones in stopping the housing booms. So those tools should be considered as well if there is a concern that asset prices are driving up credit. And I'm told to stop, so I stop. I give you some references here if you want to learn more about the IMF's approach. Thanks very much.